The last time first-time home buyers made up the smallest share of the American housing market, Ronald Reagan was in his first year in office and mortgage rates were at 18%. That was 1981. In 2026, with rates at just 6.2%, we just matched it. First-time buyers are now 21% of all home purchases, a 50% collapse since 2007, and the lowest share NAR has ever recorded in 44 years of tracking this data. Here's what's going to make every homeowner watching uncomfortable. The reason first-time buyers have disappeared isn't because they don't want homes. It's because renting a starter home is now $920 a month cheaper than buying one in all 50 of the largest U.S. metros, every single one, for the 32nd consecutive month. In Austin, buying costs $1,719 more per month than renting. In San Jose, it's $2,425. That's not a lifestyle choice anymore. That's a mortgage payment on a second house. And sitting on top of that cost advantage are 45 million American renter households who have quietly figured out they hold every card in this market. When the only pool of demand that could absorb your listing is $920 a month cheaper renting than buy your house, they're not coming. Not this spring, not this summer, not at your asking price. The renters, not the Fed, not the builders, not the investors, are crashing the housing market from the bottom up. The typical U.S. asking rent in early 2026 was $1,895 a month, up just 2% from a year ago, the slowest annual rent growth since December 2020. Before the pandemic, single-family rent growth averaged 4.3% a year, and multifamily averaged 3.6%. Today, those numbers are 2.7% and 1.4%. Rent isn't just cooling, it's the coolest it's been since the recovery years after the 2009 financial crisis. The reason is simple. The rental market is drowning in supply. The national multifamily vacancy rate hit 7.3% at the end of 2025, a record high. The average apartment unit is now sitting empty for 39 days before it gets leased, more than twice as long as at the 2021 peak. Nearly 40% of all rental listings on Zillow are offering concessions to new tenants, free months of rent, waived deposits, reduced fees. In Denver, the concession rate is 68.6%. In Austin, it's over 63%. Cotality reports single-family rent growth sits at a 15-year low of just 0.9% year over year. The renters sitting across from property managers right now have more options, more power, and more money to keep every month than at any point in the last decade. So here's the open question every homeowner needs to answer. If the person supposed to buy your house next spring is currently in an apartment getting 2 free months of rent and a waived deposit, why are they suddenly to take on a mortgage payment costing them $900 more a month? That question is about to rewrite what your home is worth. The gap between owning and renting right now is not just notable, it's historic. According to a February 2026 analysis from Construction Coverage, the typical monthly mortgage payment, including property taxes, is now 20% higher than the typical monthly rent nationally. Out of 838 U.S. cities analyzed, only 9 still offer a cost advantage for buyers. In more than 100 cities, the median monthly mortgage payment is more than double the median rent. In real numbers, a median U.S. home at $360,727 with 10% down at 6.23% carries a principal and interest payment of roughly $1,990. Add property taxes, homeowners insurance, and PMI, and the real out-the-door monthly payment lands around $2,750. The national median rent sits at $1,669. That's a monthly gap of $1,081, or $12,972 a year, that a renter keeps in their pocket instead of handing to a bank. And that's before maintenance, HOA fees, and the roughly 8% in closing costs the seller pays when they eventually move. Since January 2021, mortgage rates have more than doubled and home prices remain 33% higher. That combination has produced the largest reversal in the cost of owning versus renting since Zillow started tracking the data. The people who feel that gap every single month the 45 million American renter households, are the exact same people who used to keep home prices rising by graduating into ownership. That graduation has stopped. Before the 2008 crash, first-time buyers made up 40% of every home sale in America. Today, they make up half that. NAR's own deputy chief economist said it directly. The share of first-time buyers has contracted by 50% since 2007. The share of home buyers with children under 18 hit a historic low of 24%, down from 58% in 1985. The median seller has now owned their home for 11 years before selling, the longest tenure ever recorded, locked in by 3% mortgage rates they can't afford to give up. The Mortgage Bankers Association, Redfin, and NAR disagree on exact median age of a first-time buyer. Estimates range from 32 to 40, but that disagreement is actually more damning than any single number. What all three sources are telling us together is that the organic first-time buyer, the young working or middle-class American without family assistance, is disappearing. The people still buying homes in 2026 are older, wealthier, and increasingly dependent on outside help. NAR's own data shows 22% of first-time buyers relied on gifts or loans from family to close. Another 26% pulled money from 401s, stocks, or crypto just to assemble a down payment. That is not a healthy demand pool. That is a demand pool on life support. For those who believe institutional investors are secretly still buying through shell LLCs, the data says otherwise. Parcel Labs uses entity resolution technology to map every LLC and subsidiary back to its true parent owner, cutting through the shell company structure entirely. What they're seeing, large institutional investors are net sellers of single-family rental homes and have been for 2 years. In Dallas, institutional investors own 9.2% of the housing stock, but account for 22.8% of new for-sale listings. In Atlanta, one of the most heavily investor-owned markets in America, institutions are now selling 2 homes for every one they acquire. Blackstone's institutional single-family home purchases are down more than 90% since 2022. The 1,000-plus unit portfolios have shed about 4,000 net units since March 2024. Parcel Labs co-founder Jason Loris told CNBC, "Rents are not holding up relative to what investors can get if they sell. For them, it's better risk-adjusted returns to just get the cash and see how things pan out." The biggest single-family landlords in America are looking at the same rent data: 7.3% vacancy, 15-year low rent growth, 40% concession rates, and doing the math on whether it's worth holding those houses. For thousands of them, the answer is no. That hidden inventory is landing in a market where first-time buyers are at a 45-year low and renting is $920 a month cheaper than owning. When you put every data point together, 4 forces are compounding simultaneously. Renting is cheaper than buying by $920 a month in all 50 major metros. The rental market has record high vacancy, 15-year low rent growth, and landlords offering concessions on 4 out of every 10 listings. First-time buyers are at their lowest share since 1981, and the organic first-time buyer has essentially vanished. And institutional landlords have shifted from net buyers to net sellers, dumping inventory into already softening conditions. These forces don't just exist side by side, they feed each other. Soft rents keep renters as renters. Locked out renters keep buyer demand low. Low buyer demand keeps home sitting. Home sitting push investors to exit. Investor exits flood more inventory in. And it compounds every single month. We're calling this what it actually is: the silent mortgage strike of 2026. 45 million American renter households have quietly decided the math doesn't work, and they're not signing up. Rent is cheap. Their landlord is offering 2 free months. The $920 a month they're saving is going into a high-yield savings account earning 4%. They have no incentive to move. And every day they stay put as a day the housing market loses a little more buying pressure. According to Realtor.com's 2026 Generational Trends Report, 1 in 2 recent sellers has had to reduce their asking price 4 or more times. That is not a market where buyer demand is about to bounce back. If you're a homeowner, stop thinking about your home value as a function of what you paid or what it was worth in 2022. Your home value in 2026 will be determined by what the renter across town is paying, because that renter is a demand pool that sets your comparable sales. Every month, the rent versus buy gap stays wide. Your leverage erodes. If you're a seller, price reductions are no longer a sign of weakness. They're the cost of admission. The sellers who get out this year with an honest price are the ones who win. The sellers holding out for 2022 peak numbers will still be on market next spring, watching institutional listings pile up around them. If you're a buyer or renter, you have actual leverage for the first time since 2019. The math has never favored renting this decisively in the modern era. You have time options and a $920 monthly cost advantage. Use it. Renting is cheaper than buying in all 50 metros. First-time buyers are at 1,981 levels. Wall Street is cashing out. Rents are still falling. That is not a market out of bounds. That is a market in the middle of a reset, and the renters are the ones writing the rules.